big study on the SEC and climate change. Whenever I do a study, I discover something that I didn't expect. I mean, we go in with a preconceived notion, all of us do, uh, and we learn things. Let's set aside for a minute what they're trying to do. What did you learn that was different than you expected, or anything?
Well, I think what was interesting is just when you dig in, just figuring out exactly how some of these regulations are designed to work. And there'll be unintended consequences, but, I think you really have to, get down and then see how and think through exactly what the outcome is going to be of some of these disclosure rules, which, disclosure sounds very benign, very
Yeah,
positive.
yeah,
Having worked in the markets for 40 years, yeah, more disclosure is better because then you can make the best investment decision
sure.
possible.
Yeah,
And, I think that's the thing to keep in mind around all of these financial regulations. Here in the US with the SEC, the other financial agencies are doing the same. And then over in Europe, they're ahead of us in terms of passing a lot of these rules. But when you dig down into it and actually think through exactly what the outcome will be, it's the exact opposite of what they're telling you.
that's the key. Is that the law of unintended consequences? Of course, we should come back to what this rule is about. What the Securities and Exchange Commission, the SEC, is proposing sounds benign, is for companies to disclose their quote carbon footprint, something about their emissions of carbon dioxide from using hydrocarbons, from using coal, oil, and gas. Right? It's the essence of what they're asking. It seems like a simple ask. Just tell us what you're emitting somewhere, somehow, by virtue of your existence. Is that the essence of the rule?
Yeah, it's basically trying to impose a carbon litmus test on the investment universe and on companies indirectly,
Yeah.
because the way ESG, which environmental social governance investing, which has been pushed on the markets by government indirectly over the last decade or so, the way that works, and it's all focused on climate change. That's the number one priority for
Right.
ESG as opposed to DEI and some of the more culture war issues, I would call it. But it's all about climate change.
And to be clear, climate change, in terms of functional reality, is all about consumption of energy, fuels. All the policies are focused on the fuels used by organizations that lead to carbon dioxide emissions. So climate change, in this sense, is a pure surrogate for energy policy.
Yes, I mean, and that's the other thing to keep in mind when we talk about all of this. It's targeted at the energy sector, and being an analyst and investor over the course of my career, I could see that clearly over the last tail end of my years on Wall Street. They're coming after the energy sector. They
Sure.
may see it in a different way that it's all about reducing emissions and it's for everybody. But the only way to reduce emissions is by taking down your production of coal, oil, and gas, right? So that's what
Right.
all this is designed to do.
Exactly. Both directly and indirectly. Because if you're targeting a power plant that burns coal, it's not complicated to disclose the coal consumption because they have to buy it. So it's not a disclosure, it's just a fact. But if you're targeting we'll say an aluminum producer and ask them, or aluminum fabricator, and ask them what their carbon footprint is, they have to guess where their aluminum came from, who made it. And 60% of aluminum is made in China on coal-fired grids. So they're asking us to chase the supply chains up, right, to who the suppliers are of the materials that you use and the services that you use.
Right.
They're disclosing things that you might know or might not know. You have to figure out, spend some time and money finding it.
Oh, this is an incredible time sink. And I will tell you that most people who work on Wall Street do not think that this is an investment risk or a financial risk, despite
Right.
what some of the leading CEOs may be saying,
Yeah.
because it's good for their business. But these are non-financial factors. If climate is an existential threat, then that is the domain of government.
Yeah.
And government should not be trying to co-opt the private sector and the private financial markets to basically do its dirty. And then the other point about ESG and all of this, it's not like standard analysis where you're trying to get data and then make an investment decision. With ESG and the climate emissions data that it really focuses in on, once you get that data, then you go back to these companies and force them to change their behavior.
or
So
or,
this is
or
all about trying
try
to change corporate
right,
and investor behavior.
right. So and when you said the rules are an incredible time sink, of course, that's not a difficult code word. Time sink means somebody spending a lot of time, a lot of somebody's trying to figure out how to answer the disclosure questions and rules. And I've seen numbers, and it's really be impossible to guess, but the SEC is supposed to try to guess, of tens of billions of dollars of additional costs to American industries that are public companies to try to figure out how to report and manage these requirements. I mean, have you heard numbers? Have seen numbers? I mean, it's just a guesswork at this point, but they're huge.
Yeah, I mean, if you just look now, most companies produce a sustainability report
Right.
every year on top of filing a 10K or 20F. And in talking to a lot of these companies, that is as much of a project in terms of cost and time spent as filing with the SEC. And now you're to layer on top of that very minute detail in terms of disclosure around, again, issues that are not really germane to an investment decision, but it relates to weather, transition risk. Again, all of that is captured in the standard risk disclosure that you already have. And again, it's not being demanded by investors, despite what the SEC is trying to say.
Anyways, I guess Paul. Sorry, we can pick up there. My apologies.
No problem.
Fortunately, we're doing recordings. So I think the thing that to come back to is your key point is that the administration it's been open about this. The all of government approach to dealing with quote climate, which again is dealing with energy. This is a particularly damaging. Setting aside all the other things that we could talk about that are damaging, financial markets that function well and are regulated, if you like, by the SEC. It's the hallmark of what's different about the United States compared to almost every other capital market. It's destroying that is an existential threat, it seems to me.
Yeah, I mean, that was the other thing that was surprising, and just in thinking this through, it's clear that the climate agenda is a two-tiered system, and it's only being imposed on developed economies, and then developing countries get a free pass, right? And that's clear from the behavior of China and India and a number of others that continue to burn fossil fuels, raise their living standards, and then in the US and Europe, we're doing the exact opposite, right? And eventually, that's going to have more cascading negative impacts on the US economy, because we won't be able to transition from coal to natural gas going forward, because that's no longer allowed by the environmentalists. So it's going to place the economy more at risk. But in looking at the SEC rules and some of these other financial regulations, the end result is going to be that it's going to drive capital from the US financial markets and the European financial markets. They're going to be riskier. They'll have less choice. They'll be more volatile. They'll be more like an emerging market than a developed financial market. And so you're going to drive capital out of our financial markets. You're going to drive jobs and industry out of our economies.
Right.
All because of this chasing of an existential threat, which if you look at the data and the models in that, it's unclear whether that really is something to be worried about.
Well, in fact, this is the key issue that you and I've talked about is that whatever you think about the science of climate change, it's realized in everyday experience by the weather, by definition, right? The climate creates conditions for weather, storms, floods, drought, whatever. In financial markets, it just strikes me, I'm not a financial expert, but I know something about the physics of the planet. If financial markets are dealing with weather, that strikes me as insurable. I mean, the insurance companies, to the extent that they study and worry about weather in the predictable future, they charge insurance premiums to businesses. The only thing you really need to know is a disclosure, if you're looking at a business, are they properly insured to cover the kind of weather that their particular business could impact?
Yeah, no, the climate physical risk that the SEC, wants companies to capture or report on in detail is basically weather, right? And weather has never been a factor that poses a systemic risk to the financial markets. Even in very bad hurricane seasons like 2005, when we had Katrina and Rita within 4 weeks hit Louisiana, even then, it didn't disrupt the markets, either the equity markets or the credit markets at the time. And if you look at natural disaster, weather-related losses, they've been well below 1% of GDP, even in bad storm years, right? So it's not a big number to begin with. And then if you look at the insured component of that, it's even less, right? So the insurance market has been able to manage this risk and mitigate it for companies up until now. And, there is no issue. A lot of the insurance companies, I think, though, are trying to toe the party line with regard to ESG and climate change. Right. So they will put out pieces talking about that. But if you go into the data, you can see that weather-related losses as a percentage of total P&C losses is 20 to 25%, even in bad storm years. So the weather is not getting worse, and it clearly is not a financial market threat.
And even where your data shows when weather has gotten worse, because weather has episodes of, quote, the new word extreme weather, they are a trivial share of the sort of damage or risk to financial markets. So this raises the obvious point, right? The SEC is fixing a problem in its purview that doesn't exist. And the extent to which it's a transparent attempt to circumvent the long term, the sort of the 1 century claims about climate change in the far future, this is not an SEC job. This is open debate. If Congress wants to make these bets, in which some cases has in other countries, this is an open government macro issue, not a securities issue.
Yeah, I mean, and if you're using every weather event to prove the climate argument, obviously that is problematic. And then climate changes over decades. And a lot of these weather phenomena, hurricanes, they also move over periods of decades, right? So, I've lived long enough to know that a lot of this is not extraordinary in terms of having 1 or 2 severe hurricanes make landfall in the U.S. in any given year. But I think the way this component of the SEC rules work is that it just reinforces the narrative. Right? If every company is reporting, and remember, they'll default to a very low standard, so they'll go over and above in terms of disclosing potential weather risks. So that will reinforce to all the market participants that, oh yeah, weather equals climate, and it's something to keep on the radar screen.
Well, I think your point is the key one here is that whatever one thinks, I mean, the debate about the accuracy or the urgency of climate change science modeling from the viewpoint of how it impacts the business, it's the weather, and from the viewpoint of financial markets, it's an insurable feature, which is transparent, already covered. So we're adding a role for the SEC, to your point, that is not adding transparency to things that matter to the financial markets. It's adding, quote, transparency to issues that are not relevant to the financial markets. So right. Do you think, I mean, you're not a lawyer, I'm not a lawyer, but when you look at the judicial review that's underway and sort of thinking about, if we're trying to guess 2 things, how do you think the review, there's a legal review underway in the circuit court, which way you think they're gonna go, this particular court? Do you have based on what's happened, do you have a personal guess?
I would like to think that, given that conservatives outnumber liberals on the court, and the recent rulings in West Virginia versus EPA, and then the overruling of Chevron deference, that should give a good tailwind to the arguments being made by the various lawsuits that have challenged the SEC rules. So it's a major question.
Yeah.
When you talk about energy and economic policy, right? Yeah. Those are matters that are left to the Congress. Congress has not ceded that authority, certainly not to the SEC or the EPA or any of the other executive agencies. But the fact that it's the top cop for the U.S. financial markets trying to change the energy mix ostensibly to lower emissions, clearly they're overstepping, their mandate.
Well, to me, is again, looking from the outside in legally, it seems right. But we've seen cases and other domains where the court will rule, let's say, and it should not be a matter of political conservative versus political liberal, but rather call it jurisprudence conservativeness versus the alternative. But the court could say this is inappropriate, don't do it, you can't do it. And the agency can then rewrite a portion of the rule in a fashion they claim and think satisfies the court's objection and just issue the rule. I mean, that's just what the pattern has been in the past. And then you're having to sue them again. I mean, that feels like there's a coin flip option that's what the SEC will do. That they will be restrained in some fashion by the court, and they'll just modify and reissue. This is not unlike the student loan forgiveness issue, where the Supreme Court itself weighed in and said, you don't have that authority, the administration, the White House, and they've been forgiving huge swaths of student loans, as we all know. When that happens, we're back to Congress, right? And Congress has demonstrated clear lack of willingness to exercise its authority so far.
Yeah, I think, depending on what happens this November, if the right majority is in place and the consensus is there, Congress should basically reclaim the field with regard to climate policy, which is energy policy, as you say, at the end of the day, and claw it back from all of these executive agencies. But you make a fair point. The other side, it has been at this for decades. Yep. They are not going to give up. So if they suffer a loss judicially, they will just rewrite it and then come back. So that's why it's important that, if we have a Republican administration, from 25 forward, and that when we have the required congressional support, that you claw back and regain a lot of this ground, because this is a non-democratic agenda that's being pushed on the U.S.
Sure. I mean, well, you could, to be cynical, the democratic process that led to the current administration, whatever we think about it, is caused we are where we are. Elections have consequences, they say. But let me, if I'm a market player, if I'm an investor, then I'm gaming it this way. Assume, for the sake of argument, it doesn't really matter whether or not the court restricts or the SEC or not, that it modifies the rule, and regardless of the election, immediately after the election, issues the rule, a rule in some form, because whoever the new administration is, it's not taking any power until after the end of January. So now we have November, December, and January, 3 months, and the SEC has issued this rule. Because once you issue a rule, clawing a rule back is much harder. Reversing a rule is harder than stopping a rule. It's possible, but just administratively, it's harder. So what do markets do? Let's just game this. I mean, in terms of a risk factor, the election happens, the SEC feels its oats one way or the other. Either they're desperate because Democrats lose, or they're feeling bold because the Democrats won. Either way, they issue the rule. Do markets react, do you think? I mean, just speculating?
Well, I guess it all depends on who wins the next election and who controls the White House, right? So if it's just a lame duck flailing by the SEC because the courts side with them in the interim, then the markets probably just wait to see what happens under Trump if he wins, right? If the Democrats, hold on to the White House, then I think policy is going to take a more dramatic shift, if that's even possible, from the last 3 to 4 years under this White House, which clearly has
what does it mean for because this is really on the stock market here, and we all know how dangerous it is to speculate about market directions, but this is a massive headwind for the stock market if the rule goes into effect, it would seem to me.
Yeah, I think the market will probably, no matter who wins, it'll probably take an initial wait-and-see attitude. I think Wall Street, to its discredit over the last several years, has kind of been missing the forest for the trees around ESG and climate, and some of the negatives that's going to, develop, if we actually follow through and decarbonize the financial markets by 2030. So it's really going to kick in, I think, over the next couple of years. But again, if the rest of the policy agenda gets more dramatic, you're going to see more extreme measures, certainly over in Europe. And, it's my personal opinion that Europe will be the first where the investment community wholesale starts to disinvest from the oil and gas sector, right?
Right.
And then I think we'll have to see what happens here. But, I think initially there'll be a wait and see, and then let's see what the policy agenda of the second Democratic administration is going to be. And then if Trump wins, see exactly how his policies will change, and will he be more aggressive, again, regaining territory.
Yeah. Well, the interesting point you made here, of course, you're a Wall Street veteran. I'm a Wall Street observer. I dabbled in Wall Street for a while as an advisor. You said these are policies that have impact in a couple of years, which I agree with. Problem with Wall Street is 2 years is forever, right? A lot of the traders they're thinking out 2 months, 2 weeks, depends on the kind of trader you are, 2 days, options trade, but 2 years, an awful lot of trades are not being made on the basis of what's going to happen 2 years from now. So it's a lot of very damaging things can be put in place that will not cause the kind of massive negative consequence immediately. So you have this bizarre disconnect between current catastrophic actions and consequences, which are going to happen very quickly. 2 years is not long, but for a Wall Street trader, whatever. I'm going to make the bet based on the next quarter.
Yeah, I mean, it's interesting with ESG because these are very long horizons that they're trying to tell you are important for Wall Street. 30 years, set a net zero target if you're a company for 2050. I mean, the market, as you say, it doesn't really go past 1 year because, it's all about my performance, company's performance in 1 year. And then if you work on Wall Street, it's about my personal bonus that I'll make from my performance this year.
Right.
So no one really cares. Companies have never given 30-year forecasts that are worth anything. A few months down the road, you have to. So ESG has always been this, again, non-financial factor with horizons that are not relevant to the financial markets. And again, I think that's gotten us to a dangerous place because everyone working in the market is thinking, okay, well, I'm going to keep my head down. I'm going to keep on doing what I can. And then that includes investing in the energy sector up until I can't, right? And that time, as you say, I think will come quickly between now and 2030, certainly if these SE rules are implemented, and the same over in Europe. And these European regulations will, in some way, shape, or form, splash up on our shores too, given how integrated the global markets are. So I think Wall Street will continue to kind of, again, miss what's going on here, unfortunately, until it's too late.